As the U.S. stock market is currently in its pre-market session and not yet open for live trading on Monday, October 20, 2025, we are looking at the most recent closing figures. Beyond Meat closed the last trading session on Friday, October 17, 2025, at $0.65 per share, which was a massive single-day surge of $0.13, or 24.15%. Now, before anyone logs into their Robinhood app or checks their Fidelity account thinking the company has been saved and the plant-based revolution is back on, we must be exceptionally clear. This 24.15% spike is not a signal of a fundamental recovery. The expectation, seeing a green number that large, is that some incredible news dropped, a buyout, a massive new partnership, or a stunning earnings beat. The reality is that this is one of the most dangerous kinds of market movements. This is a technical, chaotic, and likely short-lived spasm in a stock that is, by all financial metrics, facing an existential crisis. When a stock trades for pennies, tiny shifts in capital can create enormous percentage swings. This isn't institutional accumulation. It's a combination of a desperate short squeeze, algorithmic trading, and retail speculation on a name that has fallen over 99% from its all-time high. This is the financial equivalent of a distress signal, not a sign of returning health. Let's really get into what this movement signifies. The common belief for years was that Beyond Meat was the next great growth story, a true disruptor, maybe even the next Tesla stock, but for the food industry. The expectation was a smooth upward trajectory as the world adopted plant-based proteins. The reality, as we see from this $0.65 price, is a catastrophic failure of that narrative. So what caused the 24% jump? The search results and market chatter point heavily toward the company's recent debt exchange offer. Beyond Meat has been trying to manage its massive convertible note burden. The news around these exchanges is complex, creating massive uncertainty. Short sellers who have been piling onto this stock for months may have seen a technical level break or been spooked by the high volume, forcing them to buy to cover their positions. When shorts are forced to buy, it creates artificial demand, spiking the price, which in turn forces more shorts to cover. This is a classic squeeze. But a short squeeze says nothing about the health of the company. It only speaks to the crowded nature of the bearish trade. Anyone using online investing platforms needs to understand this distinction. This isn't a stock to buy and hold in your Fidelity IRAs or a Schwab Intelligent Portfolios account. This is a trading vehicle, and a highly dangerous one at that. The trading volume on Friday was huge, many multiples of its average. But again, who is trading? It's not Fidelity Investments or major pension funds building a new long-term position. It's day traders using Robinhood stock trading or SoFi active investing platforms and hedge funds managing their short exposure. The stock recently hit an all-time low of just 50 cents. This 24% move, in absolute terms, was a jump from 52 cents to 65 cents. We are not talking about a move from 52 to 65. The market capitalization of the entire company is now well under $100 million, a complete shadow of the $14 billion it was worth at its peak. This kind of volatility is why many automated investment help services or intelligent portfolio systems would screen this stock out entirely. The risk profile is simply unacceptable for a stable, long-term investment. It's a gamble, not a placement of capital. For any investor who is new to this name, or perhaps is just checking in after a long time, let's establish what Beyond Meat was supposed to be. The company designs and sells plant-based meat substitutes. Their flagship products, the Beyond Burger and Beyond Sausage, are made from pea protein and are designed to look, cook and taste like real beef and pork. The expectation was built on a simple premise. As consumers become more health conscious and environmentally aware, they would ditch animal protein for these superior plant-based alternatives. The company secured massive food service partnerships with chains like McDonald's, Yum Brands, KFC, Pizza Hut, and Starbucks. It landed on shelves in every major grocery store. The story was perfect. It was a high-growth, high-margin, tech-like food company. Here is the brutal reality. The product is not superior. It is a niche, ultra-processed, premium-priced food item. The taste, while an improvement on old-school veggie burgers, was not convincing enough for mass-market adoption. The price remained significantly higher than traditional meat. And crucially, the repeat buy rate, the metric that determines the success of any consumer packaged good, was terrible. Consumers tried it, but they didn't come back. The major partnerships all fizzled. The McPlant burger was discontinued in the US. The KFC trials faded. The reality is that the addressable market was a tiny fraction of what was promised. Competition also exploded. Every major food company and an army of new startups launched their own products, crowding the shelves and killing margins. This isn't Apple stock, which commands massive margins through a locked-in ecosystem. This is a commodity food product fighting for shelf space. This brings us to the financials, which are the core of the problem. Beyond Meat is burning cash at an unsustainable rate. Their quarterly reports for the last 2 years have been a horrifying cascade of declining revenues, collapsing margins, and massive operating losses. The company is in a constant state of restructuring, laying off huge portions of its workforce and pulling back from international expansion just to conserve cash. The expectation was growth. The reality is survival. And that survival is in serious doubt. The company's balance sheet is burdened with convertible notes, a form of debt that are coming due. This is why the recent debt exchange news is so critical. They are essentially trying to swap old debt for new debt and shares, a move that heavily dilutes existing shareholders. This dilution is one of the reasons the stock fell below $1 in the first place. Trading below $1 for a sustained period triggers a delisting warning from the Nasdaq. If delisted, the stock would be relegated to the over-the-counter markets, making it incredibly difficult to trade on mainstream platforms like the Fidelity mobile app or SoFi Invest. This would be a final blow. Let's think about this from the perspective of different investing sites and platforms. If you are a self-investing individual using Interactive Brokers, a platform known for its sophisticated tools, you might be looking at the options market. The Interactive Brokers trading platform would show you extreme implied volatility, making puts, bets on the price falling, very expensive. Some might try to sell calls, but the risk of a squeeze like Friday could wipe you out. For a beginner using the Robinhood app, the allure of Robinhood fractional shares might have let you buy a piece of Beyond Meat when it was $100. Now that position is effectively worthless. This is the dark side of the democratization of online investing. It provides easy access to financial ruin if you don't understand what you are buying. Platforms like SoFi, which offer both SoFi Investing and SoFi Stocks, are caught in the middle, offering access but also SoFi robo-advisor services that would likely never touch this stock. What is the future outlook here? What is the expectation for a bull case? Honestly, there isn't one based on fundamentals. The only realistic positive scenario is a buyout. The hope is that a massive old guard food company like a Kraft Heinz or a Nestlé will see the brand recognition, which despite the collapse is still high, and decide it's cheaper to buy Beyond Meat for pennies on the dollar than to build their own plant-based brand from scratch. That's it. That's the entire bull case. The hope is that the company gets acquired for, say, $1 a share. This 24% spike is likely feeding on that slim hope that this volatility is a precursor to a merger announcement. But the reality is, why would an acquirer buy the company now and take on all its debt and liabilities? It makes far more sense to let it file for Chapter 11 bankruptcy and then buy the valuable assets, the brand, the patents, the factory equipment, for even less, free and clear of the debt. That is the far more likely scenario. The risks are clear and present. The primary risk is $0. The company fails to restructure its debt, the cash runs out, and it files for bankruptcy, wiping out all equity shareholders. Anyone holding this in an individual brokerage account, whether at Fidelity, Interactive Brokers, or Robinhood, would see their investment go to zero. The recent launch of their new BYND IV burger, a new formulation meant to be healthier and tastier, is a too little too late effort. The expectation is that this new product will reignite sales. The reality is that the brand is damaged, the category is saturated, and consumers have moved on. It won't be enough to reverse the